The first one we're going to be doing is the Spooky REITs. All tricks and no treats whatsoever.
Everybody wants to avoid losses and yield traps, right? Nobody wants to buy into a sucker yield.
Really, since 2020, they've always been this quasi-sucker yield, which means this yield is too good to be true.
I'd much rather get a safe, reliable 5% yield than take my chances with that 9% yield, because as we say, when dividends get cut, share prices follow.
Hi everyone, it's Brad Thomas and welcome back to the Wide Moat Show. We've got a special week this week. We're actually going to publish two different editions of the Wide Moat Show, the Halloween edition. So I'm really excited about that. And Nick, if you can tell, I didn't have a costume today.
Yeah, no, me either. It's hard, I talked to Brad yesterday. I'll let him tell the story. I think he had a hard time finding an appropriate costume for a Wall Street analyst. So Brad, go ahead. I'm just happy that we're not dressed up today because I didn't want to have to buy a costume either.
Well, that's good. Actually, years ago, I built the store for Party City, which had all of the Halloween costumes. And of course, Party City filed bankruptcy. That location that I built is no longer there. And so, look, I think most people are getting like Halloween costumes online today. I think that's at least, there's not as many stores as there were, 10 or 15 years ago when my kids were doing trick or treat.
Yeah, no, it's another example of e-commerce kind of taking over. I haven't even shopped this year. We have a football game on Halloween, so I don't have to trick or treat this year. That's probably the saddest aspect of coaching. I will miss trick or treating. Feel a little guilty. My wife's going to have two kids to keep track of that night, so good luck to her. I'll definitely have a talk with them about staying together and staying safe. But it is sad. I missed trick or treating this year. So I think we're going to have a party on Saturday though to try to make up for it.
Well, you mentioned football, Nick, and we've had a couple of comments in chat. And by the way, please comment below in our channel here because that helps us with new content. And one of the questions we had, Nick, was about your team, your football team, your coaching, the Warriors. So how did you do this weekend?
Yeah, no, I was surprised. When we talk about the team, I sometimes wonder, do these YouTube people even care or want to hear about this? But I think several people asked about the team in the chat on the last video. We did forget to mention it. So yes, we've won our last two games, won 50-7 last week and 60-27 this week. So the offense is firing on all cylinders. And we have the toughest matchup of the season this week. We played the number one running back in the entire country. So he's going to University of Michigan. Nobody on our team is going to the University of Michigan. So we're going to have to gang tackle and, figure out a way to stop that kid. But we're 6-2. They're 8-0. It'll be a really good game this Friday.
Sounds good. Well, I can't wait to hear about it next week. But again, this week we've got the Halloween edition. And of course, we're going to be talking about REITs. I wrote on Seeking Alpha for 16 years. And for many of those years, I would write articles, trick or treat, my favorite REITs, and some of the spooky REITs for Halloween as well. So I thought I would continue this tradition here at Wide Moat Research and do two different editions. Both of these are REIT focused. So the first one we're going to be doing is the spooky REITs. All tricks and no treats whatsoever.
Yeah, no, looking forward to it. Yeah, last week was a Knicks portfolio episode. This week is the REIT episode. So I'm probably just going to sit back and watch the master do his thing. Certainly looking forward to these, these spooky REITs. I think everybody wants to avoid losses and yield traps, right? Nobody wants to buy into a sucker yield, but it does happen all too often. So hopefully in this video, Brad, you can save some people some stress and some fear and some pain by, kind of pointing out three REITs. Is that what you're going to talk about that you do not like?
Yeah, three REITs I don't like. And speaking of last week, Nick did a great job. If you didn't watch that series last week, Nick's Picks, we'll call it. He had some great picks, but there's a lot of companies Nick has in the portfolio that are really expensive now. Now, he owns a lot of these, and he's not selling too much, if any, but maybe trimming. But the great thing about REITs is they're still attractively priced. But I want to really first do this caution video because there are REITs that are really generating some high yields and really too good to be true. So without further ado, let's get started here. Now, the first one is a small cap company. It's a specialty finance company called Sachem Capital. They're a commercial mortgage REIT, and essentially they do first mortgage or senior secured loans for a variety of different real estate categories. Mostly it's residential focused. So, they started out with these fix and flippers, but, rental properties, things like that. That's about 60% of their income they generate. They also have some commercial loans. This would be like self-storage and things like that. And then they have mixed use loans as well, and some land, a little bit of land, but mostly it's residential commercial lending. Now, what's happened with Sachem, again, they got about 226 loans. So it's a fairly diverse portfolio of lending spread across about 556 million total assets dollars and in 15 states. What's really intriguing about this business is the average yield on the portfolio is 13%. So basically, they loan money out to their clients at an average rate of around 13%. Now that's a lot more than the bank, but they can get quick funding. They can come back for more, obviously, if they don't default and they're repeat customer. So that's a really interesting business model. And again, it has higher risk. We see higher defaults. What's happened here with Sachem? We have seen a number of defaults. In the second quarter, they haven't published the third quarter results yet, but the second quarter, they had around $120 million. Again, that's on an asset base, as I said, of about $556 million of non-performing loans. So definitely that's increased from about $107 million of unpaid loans, non-performing loans in the first quarter. So that number has trended to go up. Now, hopefully it's going to come down. We'll find that out in the second quarter. They had a pretty large hit down in Florida, in South Florida, with a $50.4 million, actually it's multiple loans, I think they were cross-pledged, but it was to one lender. I know that. And that was about 13% of the portfolio, that $50 million loan. So they're trying to work through bankruptcy with that particular client. We'll see how the outcome of that one is. But look, take a look at this chart. This is the earnings chart, really the earnings per share, I should say. And you can see the decline in earnings really began in 2023. Defaults, again, a lot of this is triggered by rising rates. And we had this really insatiable demand coming out of the pandemic. Again, rates were still low, but when rates started to increase, this is what happened. So definitely we saw negative earnings in 2024, only 5 cents coming in 2000, based on estimates in 2025, and about 8 cents. So not even close to recovering from kind of pre-pandemic earnings. Now the next chart is really the most important. And again, we focus a lot on dividends here at Wide Moat Research, not just in REITs, but mostly every company has a dividend tied to it. Not all the companies, but I would say a large majority of companies that we research and recommend, have dividends. And we'll talk about that in the next series where we've got those companies that we really like, the safer REITs. But this company, you can see the dividend per share history declining from a high of 52 cents a share all the way down to about 20 cents a share in 2025. Now, remember, REITs must pay out at least 90% of their taxable income. That's the law. And of course, they weren't able to pay out 90%. They couldn't pay out hardly anything because they didn't have any earnings coming in because of a number of these defaults. So we think that's going to continue. The next chart I want to show you is the payout ratio. And you can see here, Sachem has never covered its dividend. That blue line here is their earnings per share, which is set below the orange line really since 2020. They've always been this quasi-sucker yield, which means this yield is too good to be true. So even though this company is generating some pretty massive yield right now, and I think it's around 18%, I can't remember the exact number, I'm trying to pull it up now, 18.1% yield, definitely too good to be true, very likely to see more dividend cuts. So I would stay away from Sachem.
Yeah, it makes sense to me. We talk about this all the time. People get caught up in the yield, but they don't worry about their yield on cost, which is you always want to see that going higher, not lower over time. So, somebody that bought this company when it was yielding 50 cents a share, like you said a few years ago, they're not feeling very good at all about this 20 cent per share dividend on an annual basis. They're making less than 50% of what they were when they originally bought in. So sure, the yield looks good, but the yield's only high because the share price has fallen alongside its deteriorating earnings and dividends. So yeah, I agree. I don't follow this company closely, but just looking at the chart, quickly looking at the numbers, it appears to be a sucker yield, and it's not something that I would sleep well at night owning.
By the way, before I get into the next one, I just wrote an article today for Wide Moat Daily, so please follow our free content at widemoatdaily.com. I just wrote on a new company that we initiated coverage. I'll let you read about it. And the article comes out tomorrow on Tuesday, which of this week. However, this company has a dividend yield of 9%. And, I've done a lot of research on this company. Again, I wrote the paper on it this morning. We're recommending this company, and we think it's very sustainable. This 9% yield, plus it's cheap. So I think capital appreciation and that 9% yield could really make this a compelling opportunity. So take a look at that at the Wide Moat Daily. Now, the second pick is called Gladstone Land. Now, they're externally managed by this company called Gladstone Companies, which is a pretty large registered investment advisor with over $4 billion of assets under management. So they've got a big parent company. Gladstone's relatively small. They've got 150 farms spread across about 103,000 acres in 15 states. They do have exposure into California as well. So something to always point out. Now, the dividend yield today is about 6.1%. So it's not extremely high. Now, for a farming REIT, it is. What really has gotten me concerned is this comment that the CEO made in the second quarter earnings call when he said, we have moved from being a lesser and more of an operator or a grower of sorts because we're taking some of our payment for the lease in part of the crop that is being grown. So in other words, they're kind of being an operator and a landlord as well. And they're taking on that risk because their customers aren't able to pay the full rent, contractual rent. So in the second quarter, as a result of some of these customers that are having some problems, they recorded a net loss of $7.9 million, which equates to adjusted funds from operation being negative $3.4 million or 10 cents per share compared to $3.7 million in the second quarter. And that's positive. So AFFO share per share is continuing to fall. You can see this chart here. This shows the AFFO, a high of 72 cents coming out of COVID, really started to accelerate. And then they just started to fall. They went to 57 cents to 47 cents. And this year, they're probably going to be around 23 cents. AFFO per share, this is the analyst estimates. So when you go to the next chart here, this is the dividend chart. Again, dividends are extremely important and a really good indicator of the financial strength of the overall company. But you can see this company, now they have had some modest dividend increases, you can see along the way. So that looks pretty good on paper. But let's go down to the next chart. And this is the payout ratio. Again, that blue line represents the dividends, the AFFO per share, the earnings, and the orange line here represents the dividend. Now you can see that drastic decline in earnings or AFFO per share, which now puts this company into a sucker yield category, which means that dividend yield of 6.1% or so is really too good to be true. We expect to see a likely dividend cut with this company. Very possible. They actually, another one of their companies, Gladstone Commercial, cut their dividend just maybe about 2 years ago. Same thing. They were they were sucker yield, so they weren't paying out enough earnings to cover that dividend. So that's one we definitely would want you to avoid right now.
Yeah, no, you got to love that, predicting the dividend cut, trying to keep people out of trouble. It's interesting because farmland is, people talk about that as kind of an asset that the uber wealthy, the Bill Gates, the Ted Turner, there's all these kind of famous people buying up farmland because of it as a kind of safe haven asset. But I think where people get confused is those people, they're not looking to generate high yields. They're just looking to preserve their capital. So, when Bill Gates buys up, hundreds of thousands of acres of farmland, I'm not sure that he's all that worried about generating a 6% yield. I think he just wants to make sure his money stays valuable. So, just because a billionaire does it doesn't mean it's something that the rest of us should do. And it seems like Gladstone's struggling. And the agriculture space is hard these days with tariffs, with trade wars, very unpredictable. So once again, I'm not surprised to see, kind of negative volatility with the fundamentals here. And this is not an area of the market that I would feel super comfortable investing in right now.
Yeah, I agree. And farming is a good asset class to invest in. There's another farming REIT. Actually, the same company that I just mentioned, I'm writing about the Wide Moat Daily here, is the 9% yielder. They actually are a land business. So I hope you read this story. It's a really interesting pick. Now, the final pick, the sucker yield pick, is Global Net Lease. This is a company we talked about a good bit here on the Wide Moat Show. Very similar, this company has got a dividend yield that's too good to be true, but they're also a chronic dividend cutter. Now, what's really kind of confusing here with Global Net Lease is they own 911 properties, and these are single tenant, mostly single tenant properties that have long-term contractual leases. So you would think that the revenue was fairly stable, and the earnings would be fairly stable. I mean, they've got a 44 million square foot portfolio diversified across 200 industrial properties and 647 retail properties and 64 single tenant office properties. And the average occupancy rate is 98% with a weighted average lease term of 6.2 years. So when I tell you that, Nick, it sounds like, they should be able to at least generate a very stable earnings. But let's take a look at this. By the way, the dividend yield is 9.9%. But just look at this earnings history. I mean, they've got negative earnings growth every single year, starting from 2018 all the way down to 2025. And I can't for the life of me figure out why this is good capital management. They've been able to issue shares and debt, but yet they can't grow the company utilizing these very stable leases. So it just makes no sense, really. So it's definitely clearly a management issue. Now, they were externally managed. Now they're internally managed, but still they haven't been able to turn the ship around. Just look at this dividend history. Again, this is not what you would typically see with an equity REIT. I can understand it being a mortgage REIT, which has more variable income, but this company is supposed to be stable. But look at the dividend history. I mean, just dividend cuts almost every year. So finally, this is the payout ratio. Now, again, this is not as severe as we saw with the two other REITs. Right now, the payout ratio is about 90%. But again, all it's going to take is a couple vacancies for that company to really be able to cut that dividend again. So I just don't have a lot of trust with this company, given the chronic dividend history they've had of cutting that dividend. So anyway, that's our third and final spooky REIT for the week. And Nick, do you have any closing thoughts?
Yeah, no, that company is interesting because we talk about how much we love the net lease. The such high margins, they don't have to pay hardly anything. They just collect checks from their tenants. A bunch of our favorite companies fall under that category. So it seems like Global must be trying to sort of reinvent the wheel when they don't need to, right? That's a proven business strategy to generate a lot of income, to generate a lot of growing dividends, and they just can't figure it out. So yes, the yield is attractive there, relative to the Really Income, the Agree, the NNN, a lot of the high quality names in that area of the market that we talk about here. But, I think I'd much rather get a safe, reliable 5% yield than take my chances with that 9% yield. Because as we say, when dividends get cut, share prices follow, in that downward trajectory. So once again, I like all three of these. I don't like all three of these. I like them as kind of spooky REIT picks. None of these sound like something I'd be interested in owning. And I certainly hope that, this video kind of sheds a light on these, potentially dangerous investments. We certainly don't want anybody to experience dividend cuts, especially retirees who rely on fixed income to support their lifestyle. So Brad, great video. We're under 20 minutes, which was the goal here. So we kept this one short. The first video of the week, like we said, we will be producing another video this week highlighting 3 of Brad's favorite REITs. So if you enjoyed this video, like and subscribe. And there's a notification button in the shape of a bell. You can press that. It'll give you notifications whenever Wide Moat posts a new video. And in a few days, you should get, that bell should ring and let you know what Brad's favorite Halloween REITs are. So I look forward to that video and seeing everybody in the comment section.
Great. Thank you all again. And please drop us some comments below, and we'll see you for the next Halloween video here shortly. Take care. Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy swan, sleep well at night investing.